Welcome back to the stock portfolio update videos. Today I'm going to be going through all of Google, Microsoft, and Meta's earnings and how that's affected my stock portfolio, and giving a general update on my stock portfolios as I have been selling some of my shares, as I've mentioned before, to go towards a deposit. But today's video was going to be all about the recent earnings season and how that's investing and affecting my portfolio. Overall, these are all three stocks that I've owned before or currently do own, and we're going to start off with Alphabet. So if we have a quick look, Alphabet stock rises as Q3 earnings revenue surpasses Wall Street's estimates. So Google parent company Alphabet stock popped more than 4% in after hours trading on Wednesday after the company posted a reported third quarter revenue and earnings that surpassed Wall Street's expectations, following a slew of AI deals involving its cloud segment. Alphabet reported quarterly revenue of $102.4 billion for the 3 months ending 30th of September, ahead of the $99.85 billion expected from Wall Street analysts. But that's also up from the $88.3 billion in the same period last year, so you can see there's been really strong growth. The sales growth was driven by Google Cloud, which saw revenue rise 34% to $15.2 billion from the $11.4 billion a year ago period, and was higher than the $14.8 billion projected. The segment's backlog, or value of future revenue from customers' contracts, rose to $155 billion during the third quarter. Obviously, cloud is a really big growth area for Google, and if you have been investing in the stock, you're aware that that's been one of its highest growing areas, arguably its highest growing, and it seems like a real key revenue driver, especially as we move into the age of AI. Meanwhile, the tech giant's adjusted earnings per share were $2.87 for the third quarter, was also more than the $2.27 projected and above the company's $2.12 adjusted EPS a year ago. Alphabet also upped its capital expenditure forecast for the year to $92 billion at the midpoint from its previous estimate of $85 billion. So that can obviously be taken both ways. Some people can be happy that they're investing more because they see growth opportunities, and some people can also be a bit unhappy with that because they can see that as maybe they're spending a bit too much money, maybe a bit too much cash as well as going out the door and not being returned to shareholders. But that kind of depends on how you're looking at it. Alphabet had a terrific quarter with double-digit growth across every major part of our business. We delivered our first ever $100 billion quarter, the Alphabet and Google CEO Sundar Pichai said. The tech giant has increasingly shown that it's a beneficiary of the AI boom, as its Gemini AI models have gained popularity and big-name AI developers have signed up for the cloud services. OpenAI just added Google to its list of cloud infrastructure providers in July. Meta reported signed a $10 billion deal with Google Cloud to use its services as the Facebook parent rushes to secure AI computing capacity. So overall, you can see there's been a big investment into Google and all the cloud providers, AWS, Microsoft Azure. Obviously, I own all three of these companies because I do believe this is going to be a really key area for growth going forward, and it has been so far already. So this was just a quick update on how strong the stock has been performing. And if I show you the share chart, you can see I own $9,310 worth of Google, which is around 34 shares. And I'm up around 66%, nearly 67%, which is around $3,730 with an average share price of $164. I was heavily investing into Google when they had this dip, when there was a lot of fear around the stock, around it potentially getting decoupled, where it was going through its trial, around potentially having to sell Google Cloud, Chrome. I used this as an opportunity to buy into a company that I already previously held, and I had a bit of high conviction on. The stock was trading at around an 18-19 PE ratio compared to a lot of its big tech giants, which are trading in the 30s. It did look very cheap, and it was growing. Obviously, cloud, just general ads, everything seemed to be heading in the right direction, but the stock price just wasn't reflecting that. When you look at the S&P, even the S&P and the average company in that was trading at around a 22. So Google was trading cheaper than the average company in the S&P 500. And in my personal opinion, I thought it was a better company than the average company. So it's done very well. I've been covering it a lot on this channel. If it keeps growing like this, this position could potentially hit 10,000 USD. And yeah, it's been really good for me. Such good strong gains in such a short time. You can see it's up 61% in the last year and up around 71% in the last 6 months. So if you really had conviction you were buying the dip, then you've done very well. I'm not buying any more of it at this price at this moment. Don't get me wrong, I think you can still buy in and get a good deal. Keep in mind, the stock is trading at around a 28, nearly 29 P ratio, which is still cheaper than a lot of its big tech giants. But again, I was buying it at under 20. So at that time, it felt like a really, really good deal. The next company I wanted to look at was Microsoft. Microsoft is another position in my portfolio. You can see I earn around 7,360 USD, or around 13.6 shares, and it's down today for a few reasons. So quickly, Australia wakes up to global Microsoft cloud outage. So Australia has escaped the worst of the global outage from Microsoft's cloud services, which has stopped customers from accessing its Microsoft Office software, Xbox Live, and Minecraft. So there's a bit of stuff going on with Microsoft, which will hit a lot of people when they wake up, it seems like, and they confirmed there was an outage. So they said, we're investigating an issue impacting several Azure services. Customers may experience issues when accessing services. So it's another good thing to note if you're wondering what's happening with Microsoft stock today. But to go back to their earnings, Microsoft Q1 earnings beat forecasts as shares fall on CapEx surge. So similar to Google, there is a bit of an increase in CapEx. That's capital expenditure. And so we'll read through. So Microsoft posted stronger than expected earnings and cloud growth in September quarter, but the shares fell after it disclosed a steep rise in capital spending that seemed to unsettle investors. Revenue rose 18%, driven by a 40% jump in Azure cloud services. Like Google, very, very strong cloud growth. And again, that's why I touched on before, I'm invested in Amazon, Microsoft, and Google, as I believe cloud was an area that really could have a major impact in all these stocks long term. Net income reached 27.7 billion USD and earnings per share was 3.72, exceeding consensus estimates compiled by Bloomberg. The company's total capital expenditure, included leases, rose to 34.9 billion from 24 billion in the previous quarter. So you can see that is quite a significant rise as it continues to invest in heavily meeting its growing demand for cloud and AI services. The shares fell around 3% in after hours of trading after the result. As you could see before, that's what it reflects. The stock has still done quite well in the last year. It's up 25%, so still very strong returns for investors, up 37% in the last 6 months. So this is only a little blip in the reality of things. What they said was our planet-scale cloud and AI factory, together with copilots across high-value domains, is driving broader diffusion and real-world impact, is what the CEO Satya Nadella said in a statement. It's why we continue to increase our investments in AI, both capital and talent, to meet the massive opportunity ahead. Microsoft has been heavily investing in data centers and GPUs with major deals in the US and Europe. It has also revised its agreement with OpenAI, gaining a 27% stake in the new public benefit entity and exclusive access to its technology until 2032. So yeah, it still does seem positive for Microsoft. There's a bit of fear around its CapEx spending, it seems like. But again, a lot has been priced into the stock already. You can see it's trading at nearly a 39 P ratio. A lot more expensive than the likes of Google. And again, if you take a look at a 5-year look, the stock is up 167%. So very, very strong returns recently. There's a lot being priced into this stock, whether that's from the AI side of things with the growth, whether it's just big tech in general. Obviously, lots of money funnels into them. But overall, I still think Microsoft will do well long term. I'm still up 72% on the stock, and I'm not going to be selling it after this news. But yeah, a little bit of a cutback. There's a bit of stuff with the outage as well, but that's a bit more information on what's been happening with Microsoft. And this was one of the first stocks that I ever bought. So I do have a bit of a soft spot for Microsoft, but I do believe they have one of the best business models with their reoccurring revenue, all their subscriptions. Everyone uses their services like Office if you work in a corporate environment. But the last company I wanted to highlight was Meta. So Meta's had an even further fall, around 7.55% after hours, and we'll get into why Meta's having this fall. So Meta falls 10% as strong revenue growth outshadowed by profit concerns and softer guidance. Meta's latest earnings were a reminder that even the strongest names in the market aren't immune to shifts in sentiment. With the Mag 7 trading at a record highs, expectations were sky high heading into the quarter, and when the results came in anything less than stellar, the market reacts fast. Meta's share price fell 10%, a sharp move for a company of its size after delivering what was actually a solid but not spectacular set of numbers. Its revenue grew 26% year over year to $51.24 billion. If any other companies other than the tech companies were growing at 26%, people would be over the moon. So that just shows you how high the expectations are. Supported by a 14% lift in ad impressions and a 10% increase in average ad price. In simple terms, more people are seeing ads across Meta's platforms, and each view is generating more revenue than it did a year ago. Reality Labs, Meta's virtual and augmented reality division, posted a $470 million in revenue, up from the $270 million last year. While that's a strong growth, it still only represents a very small slice of Meta's overall business and remains in early stages of scale. Despite Meta having and delivering a strong top-line growth, the sharp sell-off came down to profitability and guidance rather than revenue. A few key catalysts stood out. So a one-time tax hit and rising costs sparked profit concerns. First, Meta recorded a one-time non-cash tax charge of $15.9 billion linked to a new US tax legislation. Excluding the accounting adjustment, net income would have been around $18.6 billion, with earnings per share of around USD 7.25, representing a 19% earnings growth, which again is quite strong. However, on paper, reported net income fell to 83%, and the headline figure triggered a wave of algorithmic and sentiment-driven selling across the market. So, beyond the tax impact, the real concern was the pace of the expenses growth. Total costs and expenses rose 32% year over year to $30.7 billion, outpacing revenue growth, which is always a bit of a worry. Research and development spending climbed 35% as Meta doubled down its AI infrastructure and generative models and its superintelligent lab initiative. General and administrative expenses nearly doubled, reflecting higher legal, compliance, and regulatory costs. On top of that, Meta continues to deploy large amounts of capital into data centers' compute capacity, which is starting to weigh on its margins. So yeah, Meta's facing the same thing where they're in quite an interesting position now where you want to be investing for the long term. You think there's good opportunities for growth. You don't want to get left behind. So you're investing a lot of money in talent, staff, capital expenditure, but it does hit your bottom line, of course, in the short term. So if you're a long-term believer in Meta, maybe you're not too worried. Again, the stock is still up 26.7%, like Microsoft, like Google. You kind of take a broader look, and you can kind of see a bigger story. And again, in the last 5 years, it's up 185%. So these are kind of small glimpses in the long term of things. So I think if you're taking a long-term approach like I am, maybe you still are quite positive on Meta and these other big tech stocks. Overall, my portfolio is sitting at nearly 50% in the green. This portfolio specifically is at around 68,700. And if we have a look at my holdings, you can see Amazon, Google, Microsoft, and VOO. I did sell out of Apple and Costco just because they're small positions and I was going to use that money towards a house deposit. And if we have a look at my Vanguard portfolio, you can see just the one position now, as I did sell out of all my VLC, which was the Australian company tracking ETF. So I was around 11 grand. And now I just have my VGS position, which is around $55,832. So that's kind of how my portfolio is looking today. But I just wanted to give a bit of an update on the recent earnings, which will affect my portfolio and probably yours as well, even if you don't expect it. And feel free to share your thoughts in the comments. Cheers.